So I was just trying to gather my panelists because we have the very last panel right now, and thank you for staying with us and watching this panel. I think it's going to be very fruitful, and I want to welcome my panelists.
Hey.
All welcome. Hope you're having a good day. So just to keep it up with the day and sum it up in a very good manner, we have a very good topic, a very wide topic actually to talk about. So I will just jump into the subject. So our title is the fragmented markets, where liquidity, market structure, and capital formation is evolving. And when we're talking about fragmentation, maybe I'm sure you have some, you want to just express a few things about how fragmented the markets are and what challenges you are facing with. So maybe as a very first sentence, I can just give word to you, and then in terms of fragmentation, what is your challenges you're facing in terms of a market maker like Keyrock? Can we just hear from you?
Yeah, sure. It is working, perfect. The market is fragmented for sure, so I think what you said is quite clear. It is difficult to transact in that market. It is difficult to find the right price and know where to execute, but Keyrock should be, or a market maker generally should be a layer of answering this issue.
Yeah.
So it's difficult for me to open and say what are our challenges, where we should be for the rest of the people, the first answer, because we aggregate prices, we aggregate liquidity, and we should be there to help people navigate that fragmented market. Having said that, we do suffer as well from that fragmentation because of the way we allocate our capital. So for us, the main thing is capital efficiency. For us, the main thing is when we look at this market, what's difficult is to know where to allocate the capital, to which venue, how we do it. To have the capital to allocate as well, we are in an industry that doesn't have a lot of credit. When we are transacting with our own capital as well, so there is a lot of credit risk involved with this, especially when we talk about institutional size type of trading. So all of that, all these capital-related questions, something that we struggle with every day as well, and we try to find the best answer to. The second layer of it is moving capital is something that is tedious as well. So when we have a lot of capital in one venue, then moving it across another venue, or if a client asks for a token that we have available in our inventory, but in somewhere else, all of that moving and all of that operational burden that comes with operating in a fragmented market is something that for us is something to solve. And today it's not automated. We need to have people doing it because we need to have level of control. So we can automate the flow, but we cannot automate the control behind it. And we cannot automate the integrity of what we are doing. So all of that is a burden for us. That is an answer that is coming from that fragmentation in the market.
So, as for the capital to move around freely, you need to comply with the regulations, you need to meet the liquidity, and you have to be liquid, especially in order to be flexible, right? So, when I moved to Ali from ARF, which is the project I really, really admire a lot, and thank you for your efforts for the ecosystem and to the technology. In cross-border payments, fragmentation is very tangible, right? So you have to deal with different currencies, different banking rails, different institutions. From our perspective, where does the real liquidity cost arise, like for the payment companies for today?
Of course. So thank you for your kind words, first of all. We are a Swiss company, regulated and working on cross-border payments and global payments since 2022. And we saw fragmentation is really the key thing that solves the problems locally, basically. I mean, fragmentation is another bad thing for us, in a way, because financial industry is mostly not silver bullet kind of a industry. Like you create a product which solves everything in every local. I mean, it's like all the customization, requirements, regulation, and everything. This creates the fragmentation, especially the needs of that corridor or country. And we are solving this with providing stablecoin liquidity and settlement infrastructure for financial institutions all around the world. And today we are doing maybe 1.5 billion per month, but it's growing and to a, you can say, very scalable way. And this shows how even with the fragmentation and lots of solutions, there are some key aspects like liquidity, as you asked, like these are the key challenges they have all the time. So on the cost side, I think there are two things to consider. One is global payment companies are not, you can say, hardly efficient to raise a lot of capital, scalable, in a scalable way. So they are having hard time. They are using their own money. They are using their some debt maybe, etc. But at the end of the day, they have a perfect product, perfect pricing, perfect community, and still cannot grow because the product, the real product, is the money.
Yeah.
So and the money, if the money is not really around for you to raise, or banks are reluctant to increase your capital limits, other than annually, even if it's there, they are mostly stuck with growth. So that's what we are solving. So the biggest challenge and on the cost side, but before even then on the growth side, is the liquidity that they are getting or cannot getting, cannot be finding, basically. And the cost of raising the funds is really huge because cross-border payments is also a local. They are mostly local players, maybe regional, and they can access local currency. So not like USD. They can raise immediately USD funding all around the world. It's like not an easy feat for them. And the other is like you already talked about it. Like they are looking that capital for the foreseeable several days, you can say, for some time, to get that volume and process that money in those corridors. And one of the biggest challenges for them is managing the treasury opposing to the local FX positions. Like when some of the regulators even don't allow the USD balances in their own country. So whenever they send USD to their own liquidity, their own money, so they immediately convert it to local currency and keep it there for 1 day, 2 days. Even TransferWise had a 7% FX burn in on their own treasury profitability discussions. So, but yeah, I think these are the two main: raising the funds and keeping the funds in the local currency are I think the two biggest costs and or blockers.
Yeah, the idle accounts that lie on the correspondent in terms of correspondent banking and banking itself. Because I always think of, because of my background career as a banker, these idle balances held within the correspondent banks is really a huge burden for the banks as well. So what your offer is just to...
Correct. So it's like, stable coins provide a perfect solution there. Because for the first time, you can couple the monetary value with information at the same time and send to a place. And you can have them, the money, whenever they want, at that place, and whenever they want to convert at that time. So it's and what we provide is the scalable liquidity on top of that. So they are accessing that liquidity and immediately using it for sweeping, settling, whatever they need, because it's very flexible and settles in seconds, along with the data. They are using it for treasury settlements. Yeah,
so that's where the value is.
Correct, for growth and cost cutting, both.
So nice. And Danny, for institutional investors, market structure is not only about where assets are traded. It also includes custody, wallets, running the nodes, in terms of which establishment they're doing, and staking, maybe reporting. So where do these institutions typically struggle most when moving from proof of concept to scaling up? Because we have seen a lot of proof of concept trials in terms of blockchain or embracing cryptos, but what's the real difficulty for them to embrace it in a much more scale way?
Sure, thank you. I think we've really started to move out of that proof of concept stage. I think one of the reasons for that is a lot of the banks that we work with, like the Citis, JP Morgans, Goldman Sachs, it used to be an individual sitting within a vertical, pushing a rock up the hill of why you need blockchain technology, why you need to utilize digital assets and the efficiencies they will bring. And now what we're really seeing is the top-down mandates. So I think we are moving from that proof of concept to growth and scale. But to qualify where the issues lie, it is really integration into their current systems. And BlockDaemon, we consider ourselves an infrastructure player, a middleware player, that will allow you from wallets, nodes, data APIs to plug straight into your Kafkas, your Snowflakes. But it's not that the industry can't do that. The banks still have to do quite a lot of work on their side to bring that data in and normalize it so that their compliance, their risk teams can actually read and understand what's going on in the markets that they're trying to trade in.
That's the big challenge, huh?
Yeah, so for me, I know we're talking about fragmentation, but the fragmentation for me is always on the infrastructure side in terms of the operability between blockchain technology and legacy banking systems. But we are seeing a change there, and we are seeing a lot of the big banks having larger teams to work on getting that integration in, and that's again because they've got the top-down mandate. It's no longer a case of if, it's how and when.
Right. Okay. Thank you. And Marco, what do you think the stablecoins unify? These fragmented liquidity, or they just set another layer of fragmentation across the issuers, across the chains, across jurisdictions, regions, and regulatory frameworks? What's your opinion on that?
Okay. Yeah, it works well. Yeah. Can you hear me? Okay.
I cannot hear you.
Okay.
Yeah, it works.
Let's see. Okay. Yeah, it works. Okay.
Is it coming? Okay.
Okay. I tried to speak louder. That's a good question. So I think like what we did in the last years with Tether was really to be localized in a way in understanding the market and how the flows work, the distribution works. Was the main difference, I would say, between USDT and other stablecoins. We went to a market, we went to a village, we had a local person, a citizens of that country that knew if USDT was trading a discount at par, a premium, why it was trading like that, understanding like let's say the dynamics between the corridors. You know that some people from a country are selling, and that's into another country. That's why in a country is a discount and another country is like a premium. This kind of dynamics. It's really important to understand the flows. And then at the end of the day, even when we have blockchains, and I come back then to the question, I do a little wider round before coming there. So in the different markets, sometimes they ask us, I don't know, there is a blockchain, and they say like, can you push more our blockchain? And we always say, no, we are agnostic. Like we are blockchain agnostic. We help everyone, and we don't prioritize anyone. Let's say in a way, no. And how do you push a blockchain, for example? And I think ARF case could be like interesting. Now, if I would ask ARF, I don't know, a blockchain comes to you and say like, can you push our blockchain? At the end of the day, like, it's the final end user, at least this is my opinion, that determines what's happened on Binance or whatever, no? Because then, they have to rebalance the liquidity on the blockchain at the exchange level. You see like 1 billion on Tron, whatever, or 1 billion on Ethereum. But in the end of the day, it's like little OTCs and many like different exchanges, local, whatever. And all of these together make the liquidity of that market. And the liquidity of that market, then there are companies like ARF or other companies that are like flowing this liquidity. But at the end, there is the end user deciding what is or the end user or the end company deciding like what is what should be the liquidity. So then coming back to the question, I mean, if we look at it, it's not very, very fragmented, I would say, at the moment. Yes, of course, there is fragmentation, but if you go to emerging markets, you, unfortunately, almost like it would be better that it would be also much more like, I don't know, diversified, but everyone knows USDT on Tron. I mean, that's it. If you go to Istanbul, around, there is USDT on Tron. If you go to Vietnam, there is USDT on Tron. If you go to Latin America, you go to Africa, they don't tell you anything different. Like, you know, so if this was the question, let's say, I think there is not crazy fragmentation. I think there is no problem of demand, there is problem of supply, and the problem of supply, the guys like ARF are the ones that are trying to sort it out, basically. I'm talking now really on the kind of payment, traditional flows. I'm not talking like about Keyrock. This is, I would say, another different kind of job, no? Like what they do and so on. There it's more technical. There it's more, also what ARF does is technical, but it's more technical in a sense that you have like a Circle CCTP, you have a Tether-related project, USDT Zero, and so on, and then you have like different bridge version of the stable coins in different blockchains. It's a bit of more of a mess, I would say, nowadays. This will be improved and is improving day by day, I would say.
So again, maybe the interoperability and the regulatory interactions between the chains, between the regions, between the regulatory boundaries maybe should be much more flexible in order to make the capital much more efficient, because the main question, in my opinion, is the capital efficiency. Because, I mean, it's expensive, capital is expensive, and whenever you invest something, you want to earn more. So these require more yield, I mean, in terms of efficiency and yield bearing, you have to be getting much more returns on the capital, right? So this is, I guess, the main question right now. How do the capital efficiency can be created in this fragmented market? So as for Keyrock, what is your solution? I will ask this to all of you. What is your solutions in order to keep up with this fragmentation in terms of make the capital much more efficient?
I mean, that's a big question for this panel. I mean, I like it. I have an opinion, but I don't know if I'm going to solve the problem. I think if you compare to what we see in the traditional markets, trading is subsidized by balance sheets of financial institutions who do lend money to trading actors within the markets. And you can call it prime brokerage, you can call it something else. Basically, there are people, or clearing houses, or this kind of thing, there are people who mitigate the risk of trading within the TradFi world by lending capital. And this has not happened yet in the world of crypto. And DeFi is not a solution either. Over-collateralized lending is not a solution, at least not to solve that problem of capital efficiency. It is a solution for some other things, but not for that. So I think what we need to see basically is institutional or financial institutions' balance sheet come into the market. And for that to happen, it needs a couple of things to happen. First of all, the risk premium of crypto company needs to be perceived as being less than what it is today. I mean, there's not many lenders who actually want to lend to crypto big scale today. It's probably going to happen, but it's not. And then there's a couple of layers that need also to sort of align to this. The first one, I think, is...
by the way, I just saw your report, the Keyrock's report on this tokenized assets, and it's a very fruitful report. I really recommend to everybody who is interested in this ecosystem. It's really inspiring a lot and giving a lot of good data and information.
Thanks, Ebru.
So that's a very good data-based report also, which really underlines the problem and saying that all the big players, why they are not entering right now, and how they should be entering into the ecosystem. So it's very inspiring, yes.
Thank you. That's a bit of the advertisement moment of the panel. We didn't pay for that. So I have to say, I have to disclose that is voluntary.
That's not a corporation.
That is voluntary from you.
You're not cooperating, but still.
But joke aside, just to continue, I think that, yeah. So we are waiting for lending balance sheet to come into the market, and I think what I was trying to say is there are a couple of layers that still need to help this balance sheet to come. The first one is accounting. Today, in any local GAAP system or any IFRS system, there is no recognition of what crypto should be accounted for as. So that's a big thing that needs to change for accountants and for people having this balance sheet to be able to account for the risk properly.
Yeah.
I think the risk frameworks that we call Solvency II or Basel III in Europe, that have a current name in the US, need to account for crypto risk. And today they don't, or they do penalize crypto risk a lot, so they need to align to much more sort of equity-like treatment of crypto risk if we want to be able to see big lending balance sheet come into the market. So I think these layers of risk of accounting need to align, and that it needs to come from the public sector, and it needs to come from governments and from these legal frameworks to be updated in order to facilitate the entry of this lending balance sheet onto the crypto markets. And once this is done, we'll see a market that is probably a lot closer to the TradFi market than it is today, and it will sort of help with closing that fragmentation gap. It will help with the celerity of exchanging money on these markets. It will help with also reducing credit risk today. Today there's a risk if I trade with you, if I send my leg first, you may disappear after you receive my leg. And there is no mechanism really that prevents that type of risk. We have clearinghouses in a TradFi business. We have a certain number of mechanisms that do work that hasn't yet completely happened in the crypto business. So all of that needs to come together nicely in order for, I think, these lenders to come and that capital efficiency to increase drastically.
Right. Okay, I really agree. That's a good point. Like, the standardization of the accounting and the other balance sheet involvement into the ecosystem, right? And what is your opinion on this?
We are really taking this seriously in, you can say, two ways. One is really, it requires more adoption in the market, whatever it is. I mean, financial industry and the regulator will always have their own risk appetite and an openness or somewhat openness. But at the end of the day, we require to see more and more adoption on the Web3 world coming and handshaking.
On the retail side or the institutional side?
I don't care. I mean, we are more like bottom up. Sorry, we are more like top down, like more institutional. We are only working with financial institutions, banks. We don't have any retail or even business clients. But I mean, there are lots of adoption opportunities also bottom up. And we are going to see more and more. I think this is one of the key things to see better solutions to arise and the financial industry response and regulatory response to Web3 in general and more positively. And the other, for that sake, we are starting to provide financial instruments, financial products more and more for any kind of use cases we can find. So we are providing more, you can say, IBANs, if required, custody, stablecoin wallets, any kind of bridging, any kind of FX, stablecoin, any kind of use cases. We are trying to nourish and be more clear for that local. And so in that case, we are investing our time not only on the liquidity products, but also more on the regulated products, because we believe we are one of the forefront runners of the Web3 or PayFi adoption in a way, you can say, what we call like the traditional finance coming together with Web3 in a regulated way and using the best of both worlds, so the full benefits of that in a fully compliant way. So we are building all the tech stack, we are building all the regulated product stack, and on top of that, we are also partnering up with locals to bring these solutions to the far edges of the corridors. But on the second part, I think the biggest impact point is transparency. So blockchain is great for transparency, and every regulator, every bank, every partner you work with has a different risk appetite, and we should cater our solutions, visibility, and the underlying transactions, whatever happens, whatever we offer, of course, in a private, transparent way, not full transparency. I mean, of course, but they can now. What we are offering is a dashboard, like a transparency protocol that you can pick and choose. For example, as an investor to us, you can pick and choose in what kind of industries you want to fund, in what kind of transactions, in which countries you want to fund. So we can provide it on blockchain, so it's fully visible there, and they can pick it like whatever their risk appetite is, they can be there. So they don't need to now. They don't need to say us, oh, we don't work with crypto. No, I mean it's like there are lots of different industries. We are doing business for clients moving e-commerce. We are working with Amazon payment companies. We are moving money for them, and so on and so forth. I mean, they can, if they don't want to have remittances, okay, they can have B2B. If they don't want it, they can have trade finance. I mean, whatever they want. So we believe that these 2 points, trying to creating bigger adoption points by offering related products to the market and also improving the transparency are the keys to solve all these fragmented and problematic discussions
yes.
between TradFi and DeFi.
DeFi, okay. So Danny, what is your opinions on this topic, like the capital efficiency in terms of fragmented markets? What do you offer as a solution as an infrastructure providing company?
Yeah, so BlockDaemon, one of our solutions is obviously staking, which we've been doing for many years. And we get asked a lot around how do you generate yield in a safe, secure, compliant manner. And one of the things that I always have to say is BlockDaemon are one of the only providers, there's only 2, one of the only providers that when we look at staking and how we offer that yield, that do OFAC relays. Right, so when we talk about adoption and things like that, it should never be a selling point that you do OFAC relays, quite frankly. That should be mandatory. But we're getting there as an industry, and I think as we get there and prove that the products that we are putting in front of you are something that you can stand by with your regulator, with your clients, with your investors, with your board members, that's something that everyone in this space should be doing, and I think we're seeing a lot more regulatory compliant companies out there. I mean, as I said, we've got the wallet as well. And when I think about the wallet, it's what does it mean for a bank to utilize someone like a BlockDaemon's wallet? It means end sovereignty. You have ownership over it. So we develop and deploy everything on-prem for those banks. They hold all the keys. We can't see anything. We can maintain it. And it's a software license. And so ultimately, again, when we talk about that growth and scale from proof of concept, you can use a solution where someone holds a shard for a proof of concept. But try sitting in front of a bank's board, which we've done many of these, and explain that a company can see into your wallet. They know exactly what you're transacting. And I think it comes down to that transparency part that we're talking about. It's not that you don't want the transparency there for regulators, auditors, but at the same time, do you really want another organization knowing everything and seeing everything you do? That's such a huge risk for these large institutions. Even when you talk about the protocols that we would work with, ones with selective privacy, like a Canton network, right? It's really key for these banks to understand, for them and their clients, exactly what can be seen and who can see it. And when we talk about institutions, we are talking about the big banks. And there's only a few networks that they really, really are interested in when it comes to developing client solutions on. And they're likes of Canton, Stellar, Base, Tempo on the stablecoin side of things. So I think as well, there has to be more of a slimming down of what's on offer in terms of 4,000 odd protocols. They're not all going to survive, quite frankly, right? Stable coins, I think there is a good opportunity for a lot of them to actually survive. But I think in terms of just general protocols, the industry doesn't help itself by keep coming up with new things and new things that as you said earlier, who's the end user? What are they demanding? Where is the demand for it? And again, I think in terms of liquidity, that comes with that demand. And again, I think about, I think about the products that we provide, and the demand there is the capital markets divisions do want to offer crypto trading and prime brokerage to their organizations. And that's where you start to get the lending yield as well. But they will be doing it with their trusted counterpart in most instances. And there is that risk to do it with a crypto native organization. They may be able to better price you, but unfortunately there is a risk premium there that is still perceived, even though some of these companies have been going for near on 10 years.
Right. Okay, thanks so much. And Marco, I will change the question for you a little bit. So the stable coins are now leading the markets, I mean, crypto asset, digital asset markets. And when we're talking about tokenization, it's also a stable coin based on asset, right? So not it necessarily be a US dollar, it can be gold and whatever. So in terms of not only for Tether, but in terms of a stable coin issuer, in your view, are they evolving like into payment companies or financial infrastructure providers, or a new form of global liquidity institution? Because I mean, whatever I see again from Tether's perspective again, you do not have to answer it in Tether's perspective, but what Tether is been doing is getting into, as a local, a global company, getting into local and producing a new product there in order to intervene in the market or get into the market. So which way are they evolving to?
So I think different stablecoins are following different strategies. And I can make some comparisons. Of course, I can only speak for Tether.
Sure, sure.
But I would say at Tether, we try to not get into many other businesses, I would say. No? So we don't develop a blockchain. We are not developing a payment system. We are not doing all of that.
Yes.
Because if we start doing it, we are going to compete with them, right? The people that are in this panel, we are going to compete with them. And I think it's not very good to compete with those ones that gave the, let's say, the success that we have now, because it's given by all of them. And that's on the payment side. On the blockchain side as well. You know, like when a competitor of ours launches a blockchain or launches a new payment system and so on, I have all our partners telling us like, what the hell, we need to come back to you, let's say, in a way. Because they know that we are not going to enter in this. What we need to do, and basically the short answer to your question is like we have to do nothing, basically, to be successful. Because we have a very good business model. I think we have the best business model on earth, probably. Because we are like, I would say, an asset manager that takes all the yield. But if we start like cutting down the fees of our partners and to get into the distribution ourselves in that way, I think is not good. So what we need to do is to build up the tech that allows them to be faster. I think it's something that we didn't do much in the past, but we need to do more. Also, the job that our partners do or our portfolio companies do, and this is the way that we operate. We just have partners and portfolio companies, basically. And the way it works is that they have a connection with us or with another portfolio company and so on. So we need to build up the technological stack that allows them to be faster. So we need just to empower them to be successful, not do anything new, crazy, or whatever. The technological stack, what I was saying is that, for example, we'll build up like an open source, we did like a wallet development kit, SDK. Anyone can build up a wallet over our stack. We don't make money out of it. Of course, indirectly, it increases the distribution that we have, right? So it's very successful for us. But the business model and the money are made by third parties that built on over that stack. Because I believe that, and I think maybe everyone in this panel would agree, or even in the audience, is that the problem that then these payment companies have, or or even blockchains and so on, is to run the infrastructure, which is expensive, because you need to get to a custodian, to a bank. Everyone is charging you, basically. So even if we are very cheap, then they get like screwed by other parties. So we need to be very lean. We need to just do what we are able to do. We don't have to enter in competing with other businesses, basically. And yeah, I don't know if I answered like in a way. Yeah.
Okay. Thank you so much. So for the final round, I just want to hear about your opinions on how the market should evolve in the next phase in terms of capital formation, which should be quite in an efficient way. So to you, Melchior, as an on-chain asset, can on-chain asset management or automated yield strategies and new standards for tokenized vaults, are they the things that are attracting the institutional capital, or is compliance and risk management barriers are still too high for them to enter into the space? Well, which one is, I mean, is it the risk or the yield?
It's a good question. I think I like what Ali was saying just last round, which is adoption is the main driver of the market growing. And to sort of tally back to what I was saying, today it's difficult for an institution to keep stablecoins or any other cryptocurrency on their balance sheet because of the issue we discussed or the issues I mentioned on the accounting side, on the risk management side, on recognizing what crypto on the balance sheet means. The zealots can do that, so you can see the MicroStrategy, no sort of taking the risk of, taking a stance with regards to how they account for cryptocurrency, but the average CFO will not take that risk because he wants to keep his job or she wants to keep their job. So the truth is this needs to change, and I think that's the biggest sort of vector of change for me is accounting and its risk and regulations. Mm-hmm. And as soon as this changes, then institutions in a broad sense will be able to hold crypto on their balance sheet in a wider sense. Not just the zealots, not just the ones who want to do it, but everybody would be able to do so because every CFO will have a roadmap to account for it in a way that is going to be recognized by their shareholders and by everyone around them. And I think that's, to me, what's missing to really sort of supercharge the adoption of crypto. Today, if we look at the market, institutional market is just, and crypto is today just a vector for transaction. It's just to move money from point A to point B, and not really something to be held as an appreciative asset at all. And that use case of transaction, and I know some of the panelists are working towards this or with that use case, is a single use case and not the full spectrum of what crypto can do. And I think this yield you're talking about, and I think this incentive to keep crypto has to go primarily through changes at this borrowing sort of back office level, risk and accounting. Before then, CFOs are going to be happy to hold, and when we are happy to hold, we're going to get into sophistication of what it means to hold crypto. It can be yield, but it can be options, it can be a lot of structured products, it can be a lot of different sort of ways to then incentivize people and corporates to keep and hold crypto. But today, I think we need to lay the groundwork, or I think public bodies need to lay the groundwork in order for companies to feel comfortable holding these crypto assets. And today, we're not quite there yet, I think.
Right. Good point. Thank you. And Ali, as the stable coin payment volumes are growing, but real-world adoption is still developing, as we talked so much. So in cross-border payments, what are the conditions needed for stablecoins to move from promising technology to mainstream financial infrastructure? That's actually, I mean, that's all what we have talked about. Maybe you can just sum up in shortly what we have talked so far. For the next phase, how could it, should it improve?
Great question. I think we are seeing the shift not only in global payments, because stablecoins are natively very productive for global payments, but we are going to see a shift from private credit market to Web3. But we'll see. We didn't see a lot, but we'll see some glimpses of it, maybe you can say. But that's why I believe, so on the one hand, we have global payments which require the liquidity in general, for all payments, the product is the money and everything. And on the private credit market, they are looking at some opportunities, but not able to assess the risk. So, and so they cannot invest in it. So the idea here is, for us at least, I cannot talk in general, but for us is like, we are building the capabilities for ARP today to start from the initial underlying transaction with all the risks around it, and start tokenizing it and securitizing it and then distributing it, and then even to listing to exchanges. Like we are today listing our asset to a Swiss exchange, which allows everybody to, as a bond, of course, I mean, not as a IP or public offering, like we are offering that yield to the public, so everyone can, and it's fully securitized. So we will see different versions, at least in global payments, that some private credit assets will develop into more tokenized, more transparent, more secured, and more easily accessed ways of getting or buying them, selling them, trading them in a way. So I think our first next step will be around that, for enabling private credit market to come and utilize all the blockchain and all the transparency while using stable coins underlying stablecoin fueled transactions in global payments. So these are the next steps for us to see how we can bring more liquidity, more scalable liquidity, more trust from institutional LPs. So yeah, I mean, especially we will see a roadmap will develop, of course, around that private credit. Everyone is looking at that area in a way, but we are very niche still. We are only focused in global payments, and we are trying to slice it in a very transparent way, in a very secured way for the adoption. Also, not on the use case side, but also on the investor side.
Okay, thank you. Danny? So we're always talking about this real-world asset tokenization, but without the secondary liquidity and institutional grade infrastructure, tokenization can all just become just digitized illiquidity, right? So what's the minimum infrastructure stack required for tokenized markets to become truly investable in your point of view?
Yeah, it's a good question. I think it's really interesting what we've seen in the last sort of 6 to 12 months with some of the larger infrastructure, traditional infrastructure and vendors out there. I know a lot of people do get excited when they hear headlines about X bank, Y bank starting to do something within this space. The more interesting ones for me are when DTCC say they're coming into this space, when London Stock Exchange announced that they're doing the Dish network, when Broadridge announced what they're doing. Because essentially, if you're a large institution, you have to use one of those multiple times on a daily basis and pay them, right? So if they are bringing tokenization to life, all of these banks want to be involved. Now, we are, I would say, very early stages still. But I do believe if you look at, again, that kind of adoption phase where you've got your top-down mandate now, things are moving a lot quicker, risk and compliance have a lot more education on this. And an easy step for a bank is to tokenize something they know already. And they understand the underlying product. So it's just getting familiar with it. So I think, like, for me, it's the more traditional financial services coming into this space that will drive the next phase.
Okay, thank you. Marco, as the stable coins grow, like regulators and central banks are paying much more closer attention to the reserves, to the transparency, and financial stability, of course. So how should the industry build trust while continuing to innovate in this global scale?
Yes. So I think there are I would say, different realities. No, like the users of Tether, of USDT, use Tether because they have never been, let's say, left out, or and I mean in the sense we always process the redemptions. For example, no? If someone was coming to us and redeem, we always redeem one-to-one. So I remember, you know, in 2022, what was April, I think, Luna Terra crash. So we redeemed 7.8 billion in 1 week. Sorry, 7.8 billion. I don't remember if 1 week, yes, around 1 week, 5 days or whatever. And in 1 month was like 24 billions, which was more than 10% of our market cap. It's difficult, or actually it's impossible. We wrote even an article or a paper about that, to find a bank that managed to redeem more than 10% of their reserves, because they just have fractional reserves, and so they cannot just process all those redemptions. So this is what the industry should do. Like, we should just do our job. Like, our business model should be simple, and regulators should allow us to do so. The problem is that sometimes, I don't want to talk always, also in the previous panel I said like something about regulation in Europe or whatever, so I don't want always to be like annoying on that, but if the regulatory framework doesn't allow us to do that, we need to stop and we need to exit that market. And that's a problem, not really for us, because you see, when we went out from some markets, our market cap continued to grow, but it's more problematic for the liquidity of that market, because then, you know, you can have like some shocks, like it happens many times and so on. And, you know, regulation should be at least somehow shared and aligned in the different markets. Now we are fighting a lot, let's say, to have like the same kind of similar, at least, regulatory framework in different countries. If not, what you would have is that you don't know anymore if the tokens are fungible in different markets, because you don't know what are the reserves in one market, what are the reserves in the other market. So is it the same kind of stable coin in one market or the other? It's difficult to say. And so this is one reality. The other reality is the reality of journalists, I would say, because there is this other reality, or maybe also the reality of rating systems as well. There is this other reality, and this other reality is made of people that unfortunately don't understand anything about what we do and our industry. So that's why sometimes we're just like bored to even speak, to have interviews or whatever, because then you see like a rating that I think they really didn't spend like 30 minutes to understand how the stablecoin works, what's the history, what's the past, what happened and what not. The reality is that the users choose based on their appetite of risk. Okay, so if a stablecoin is bigger than another, is because of the demand. It's not that we pay the users, you know, like we don't pay anything. So if they are choosing it because they think that there is no that much risk to be with a stablecoin or another one. So yeah, that's a little bit like my point of view.
Okay, thank you. So for the final remarks, if a bank manager or an institutional executive is leaving this panel with one idea, what it should be?
Come into the market now.
For you? Don't miss the train.
No, I mean...
Jump on the train.
Apply for companies working on PayFi or the bridge between TradFi and Web3. This will be the idea for them to get, I think.
Definitely.
I mean, quit their jobs and apply for new jobs. And of course,
are you recruiting?
Yeah, I mean, of course, all the time. Anyone.
Okay, the conversation is going to another places. For Danny, what would you say to fintech executive?
I would say design and build whatever you want to do from your infrastructure properly the first time. Don't try and take the shortcuts to be the first into the market. Learn from some of those very early adopters and build it across your enterprise, not just business level, but business unit by business unit.
Thank you. That's very valuable. And you?
For me, it would be, let's say, be open and study, because there are several examples like Nokia, for example, in the telephone, in the communication industry. They had the biggest market share. Then they shrinked because the iPhone came or other kind of phones. No, so it's like open, study, maybe invest in these question marks, so that you don't remain behind. And I think that many executives nowadays are remaining a lot behind.
Thank you so much. I really enjoyed the whole conversation. I hope you did also. So I'm closing this panel, and enjoy your time after this for the night. Thank you so much, and for the listeners for attending this panel. Thank you.
Thank you.
Thank you.
Thank you. Thank you to our moderator.